Our most popular presentation thus far has been our simple, easy-to-follow lesson on life insurance. This particular lesson explains the origins of today's contracts and illustrates how we advocate for their design utilizing the reserve capital strategy, while guaranteeing the enjoyment of tax-free growth and distribution. Let's take a look at the pricing or premium structure of insurance contracts. With any contract, first we must determine the minimum amount of insurance. This is known as the base premium. This premium is directly related to the amount of death benefit you will qualify for. There is an infinite number of premium choices. For any amount of death benefit, there is a minimum you can pay and a maximum you can pay. Why? Because of the different types of contracts that are available to cover the death benefit. An example of a minimum premium contract is cheap term insurance that gives you no economic living benefits. The insurance company determines the minimum premium for these contracts. Insurance companies have actuaries and accountants that calculate the least amount of premium they can charge to cover your death benefit and still make a profit. The maximum premium that is available to deposit into a contract is limited by the federal tax code. Why is this? Back in the 1980s, the government limited the tax-favored treatment of cash value in life insurance contracts. With the revelation of how many people that were avoiding taxation utilizing these contracts, Congress passed two laws, TAMRA and DEFRA, also known as the Terrible Twins. These two laws were in direct response to an overwhelming amount of cash being injected into single premium and universal life contracts during the late 70s. These contracts were being used as tax shelters instead of their intended use, protecting assets and beneficiaries from income loss. With the passing of these two laws, the term MEC was born. What the heck is a MEC? MEC in tax speak means modified endowment contract and could make your contract susceptible to a tax consequence just like the penalties and interest on qualified accounts. At this point, we need to understand that the government will always take their part before anyone else in any financial strategy.